All right, everybody, we are back. We're here to just follow up with some details regarding class session number 3. And just to kick things off, I wanted to start by talking about what we covered in class. Namely, we began by reviewing some material regarding how to measure aggregate activity in the macroeconomy. We began with looking at the idea of national income accounting. And this was really predicated on asking the question, how much income does a society generate in a given period? And we started by discussing two measures, gross domestic product and gross national product. We discussed the differences between these two, and then we really focused on drilling down into GDP, which did not include the current account deficit. So we looked at the components of GDP, and we discussed this issue of untangling price increases when looking at the growth rate in GDP, and that allowed us to differentiate between real and nominal variables, real variables being measured in output units and nominal variables being measured in currency units, or dollars in our case of analyzing the US economy. We also discussed the limitations of gross domestic product in that it really gives us a picture of how the average person is doing when we divide by the number of people in the population, and it doesn't really give us too much information about the overall distribution of the income or of the expenditure and how that is spread out across the society. So we also looked at some alternative metrics like the Gini coefficient and how that is derived from the Lorenz curve if you were looking at the entire distribution of cumulative wealth across the population. We then jumped in and discussed how to index the price level and think about measuring the cost of living. And we looked specifically at two measurements regarding capturing the macroeconomic price level. And these were the GDP deflator and the consumer price index. The GDP deflator was predicated on measuring the ratio of nominal to real GDP, whereby when computing real GDP, we held prices fixed in a base year and we allowed the quantities to fluctuate from period to period, so that any growth in real GDP was only associated with the growth in production quantities and not prices. And we compared this to the consumer price index, which almost took an opposite approach, whereby the CPI fixes the quantities, the basket of goods and services in a base period. And this is based off of the Bureau of Labor Statistics survey of 60,000 households and regarding what a typical household consumes in terms of structuring that basket. So the CPI fixes the quantities and allows the prices to change in between periods, so that when you look at the index changing in the CPI, that is purely isolating the effects of prices changing and holding the quantities produced fixed. We then took a look at some labor market metrics, namely the notorious unemployment rate, known as U3, which measured the total number, or rather the total stock of unemployed folks as a fraction of the entire labor force. Unfortunately, we saw that relative to the entire population, the unemployment rate is fairly uninformative. And in order to get a good picture of the overall health of the labor market, needing to know the labor force participation rate was pretty crucial to give the unemployment rate U3 some contexts. We also discussed limitations to U3 and some alternative metrics like U4, U5, U6. And we also looked at the different types of unemployment, two types that contribute to long-run unemployment to the natural rate of unemployment were both frictional and structural unemployment. Frictional unemployment was the unemployment stemming from people searching for jobs and it taking time to search for jobs once you're separated from jobs. This was exacerbated by sectoral shifts, which were dramatic changes in the demand composition of the economy. Examples we discussed were things like the advent of computers, crushing the typewriter industry. So you have this migration, or rather this ideal migration of a bunch of typewriter repairmen who learned how to then repair computers. And there was a shift, and it takes some time for those people to find the new jobs. And that frictional unemployment, again, was caused despite the fact that there were enough open jobs available. Structural unemployment was the cause, a second cause rather, of long-term unemployment. And this was related to literally not having enough jobs available for the people looking. And this was related to wage rigidity. The three sources of wage rigidity that we cited were related to the minimum wage laws, which specifically affected unemployment in unskilled and teen wage sectors. The second source of wage rigidity we discussed was related to unionization of labor, which again allows labor to exercise monopoly power in increasing the wage above equilibrium. And the third source we discussed was the idea of offering efficiency wages in cases where there was a clear stratification or heterogeneity of labor quality, such that employers were incentivized to offer above-going equilibrium rates to attract better talent. We concluded by taking a step into the neoclassical model, and we looked at a quick look at the supply side and started discussing the demand side determinants. And I wanted to spend the first part of reviewing class session 3 going through this particular model. Recall that we started looking at the consumption function, which was really dependent on the disposable income that an individual had. We talked about the marginal propensity to consume, which explains how much out of an extra dollar of non-taxable income a consumer would actually spend on consumption. This was related to issues like the effectiveness of tax policy. We then looked at the investment function, which we argued was the only component of real GDP in our model here to depend on the real interest rate. And then we discussed government purchases, which we treated exogenously in that it was just fixed. The government picked the value of G, so there wasn't a complicated mechanism determining G. And we've been assuming that net exports are zero, just to, for the moment, make things simple, but we also saw it's not completely inconsistent with the numbers for the United States, and that net exports is a pretty insignificant fraction of gross domestic product. We then imposed the equilibrium condition by setting equal the supply of output and the demand of output in this model. And we argued that when looking at the market equilibrium condition in the goods market, this also imposed an equilibrium in the market for what we were calling loanable funds, which was our model's version of a financial market. The model of loanable funds, or conversely, the equilibrium model of supply and demand in the goods market, determined the value of the interest rate in equilibrium, and it also determined simultaneously the quantity of investment and savings in equilibrium. And again, this is the first idea in the macroeconomic perspective we've been taking, whereby there is a very close relationship between the market for goods and services and the market for financial assets, or in this case, specifically loans. And we looked at some fiscal policy applications, and I wanted to just kind of run through all of that again quickly here, make sure you have some reference guide for what we had covered in class. And then in the next set of videos, we will pick up talking about the nature of money and prices in the long run. So the outline of the neoclassical model, again, we were assuming here a closed economy, not inconsistent with the US data, more of a convenience assumption at this point, but we will relax that in the coming weeks. And we started by looking at the supply side. Okay, first of all, there were factor markets, capital and labor markets, in which the supply and the demand of capital and labor were determined, the price of capital and labor, and the fixed supply of capital and labor determined the amount of income the society could generate. We then talked about the three components of demand, which were consumption, investment, and government purchases in the absence of any international trade when net exports are zero. And we imposed the equilibrium condition and saw that the equilibrium in the goods market also implied a market equilibrium in the market for loanable funds. Starting on the capital side, we assumed that there were only two inputs. We kind of dealt with labor, and then we lumped everything else that wasn't labor into this group that economists like to refer to as capital. So not the first time we've seen this treatment. So we have capital and labor, and we're going to assume that capital and labor are exogenously fixed, meaning in our society we have some fixed amount of people and we have some fixed amount of, if you want to think about it, resources in the ground that we can mine and use to build capital equipment. We utilize a technology to convert capital and labor into output, as we had seen in our microeconomics unit, and the technology shows the maximum amount of output, rather, that the economy can produce from a given allocation of capital and labor. Again, this function F, this captures the economy's level of technology, and otherwise, our model of the supply side is fairly simple. We're going to assume here that the technology does not change over time, that the input values are fixed, the economy has access to some fixed supply of capital and labor, and that the economy's ability to transform capital and labor into output is again determined by the technological production function, so that for a given level of K bar and L bar, we're able to produce a given level of income or output. And again, I'm going to use the terms income and output interchangeably for the next several slides. So that's it for the supply side. The demand side, again, we had 4 components of demand for output. Once we had produced output, we could either consume that output ourselves now, we could eat it. This is what we're calling consumption. We could save that output for later. We could turn that output into a capital good where it provides us future benefits, and that was what investment was capturing. Or the government could come in and spend that output that was generated. And again, we're assuming for now that net exports equals 0 in the case of a closed economy, similar to in our microeconomics unit, how we had first looked at trade under autarky when there was no free trade, and then we compare that to the allocation when we opened up markets. The other thing we saw in class was that aside from wartime, the composition of gross domestic product in terms of its distribution across the 4 expenditure components was fairly stable. Consumption was absolutely the largest, implying that if policymakers want to stimulate growth, that is probably the best component to start thinking about. The other stylized fact for the U.S. economy was that the net exports were very, very close to 0 right now. They're absolutely negative because we are running a trade deficit that you may or may not be aware of based off of how much the White House and the president complain about the trade deficit. Here's in a slightly different picture. Actually, I'm sorry, in a minute. First, we wanted to discuss the first component of GDP, which was consumption. And we started modeling consumption as a function of disposable income, which was income Y minus the amount of income taxes collected T. And we thought about this theoretical consumption function that implied a positive relationship between disposable income and the quantity of expenditure in the consumption component. We also defined the marginal propensity to consume, which was measuring the change in consumption with respect to a change in disposable income. And we could think about, if we were to graph consumption versus disposable income, the marginal propensity to consume as measuring the slope of this consumption function. In this particular diagram, I've drawn a linear consumption function, which implies a constant marginal propensity to consume. But we also discussed in class that a more realistic consumption function might be concave, whereby the marginal propensity to consume diminishes as disposable income increases. The second key component of gross domestic product on the demand side that we were looking at in this model was investment. And we argue that investment depended on the real interest rate in the market because investment was essentially the demand for loans in the financial sector. Recall, we're using the term investment a little bit differently than in finance. Investment does not reflect buying financial assets, rather it reflects selling them. When you sell stocks or you sell bonds, you're raising equity to undertake investment. So you are using someone else's capital funds, you're going and effectively taking out a loan in order to start a business or a small business enterprise. R in our treatment here denoted the real interest rate, which was essentially the nominal interest rate but corrected for inflation. And the real interest rate captured a few things. This was the cost of borrowing. It also reflected the opportunity cost of using one's own funds or output to finance investment spending. And we also argued this was inversely related to the present value of any future benefits that would be received from running a business entity. And this implied that increasing the interest rate would decrease the quantity of investment demand, because increasing the interest rate meant two things. The loan is more costly, and the benefits from running the business using the loan are not as large, both of which disincentivize undertaking investment demand. Okay, all of this led to us concluding that the relationship between the interest rate and investment demand should be an inverse one. And the other component of spending, which was government purchases, we assumed was just fixed. The government chooses G, so we're going to treat G like a constant, as we also were T. So G and T in this context were both our fiscal policy variables. Okay, fiscal policy refers to government spending and tax policy, not to be confused with monetary policy, which refers to the Federal Reserve's control over the money supply and interest rates. Back to the market for goods and services. Okay, demand for output was just the sum of consumption, investment, and government purchases as we have described them. Supply of output, again, was generated by technology and our access to capital and labor within our borders. The equilibrium in the market, again, a similar idea with microeconomics, is determined by the allocation where the quantity of demand is equal to the quantity of supply. And this time we're going to formalize this condition in the aggregate, since we're dealing with a macroeconomic model. And we recognized that the key price that makes sure that the market is in equilibrium is, oddly enough, the real interest rate. That real interest rate is balancing, is fluctuating to ensure that the market supply and the market demand are equal in the market equilibrium. Okay, the interesting thing that we saw in class was that this market equilibrium, where supply equals demand in the goods market, also implied that we're dealing with an equilibrium in the financial market, in this market for loanable funds. The market for loanable funds was another way of using a simple supply and demand framework to think about capturing the financial side of the market activity. So we kind of have two markets in this model, two flip sides to the same coin of the macroeconomy. There's a market for goods, really in which there's only one good in our model that we're calling output. And there's a market for a financial asset, which we are calling loans or loanable funds. The demand for these funds, again, we've defined as investment. And the supply of these funds is coming from our saver. So again, when you buy financial assets, in the macroeconomics context we are using, you are not an investor, you are a saver. When you are, for example, putting your money into a savings account or buying stock, you are saving. You are giving money to a financial intermediary. That financial intermediary takes that money and uses it to undertake investment. The price of these funds, again, we are measuring in real terms. That is the real interest rate. That is the interest rate on the loans. And again, the demand for loans is coming from investment in our model. So firms, again, are borrowing to cover things like their setup costs on spending on plant and equipment, buildings, etc. Consumers also could potentially be undertaking some spending that depends inversely on the interest rate here. So again, we're assuming here that investment spending depends negatively on R. This is the price of loanable funds. And when R goes up, a few things happen. We said the cost of taking out the loan increases and the benefits of taking out the loan go down, both of which unambiguously disincentivizes the demand for loans or disincentivizes the demand for investment. So again, this suggested that the investment demand curve sloped downwards, which we had seen before. However, the supply of funds, savings, This didn't really slope upwards in the traditional sense of a supply and demand curve model. The supply of loans comes from savings, and there were two sources of savings. There was household or private savings, and there was also government savings. We had defined private savings as the disposable income minus the amount of private household consumption, and public savings was just the difference between the amount of taxes collected and the amount of government expenditures. National savings was just the sum of private and public savings. You'll notice when we add those two things together, the minus T and the plus T cancel, so that national savings is just income minus consumption minus government purchases. We also revisited the equilibrium condition for a closed economy. Again, the condition was the supply of output Y equals the three sources summed for the demand of output, which is consumption, investment, and government purchases. We were assuming net exports were zero, and what we can do here is we can subtract consumption and government purchases and move them all together on one side with income. And based on our definitions in the last slide, the right-hand side of this equation, Y minus C minus G, is by definition equal to national savings. Okay? Meaning, when R adjusts to put the goods market in equilibrium so that Y equals C plus I plus G, the market is also equilibrating to put the loanable funds market in equilibrium so that savings equals investment. Okay, so saying that the goods market's in equilibrium implies that the financial market or the loanable funds market's in equilibrium, and vice versa. Both are true. While we're here, we also want to take the opportunity to define what budget surpluses and deficits are. If public savings is positive, if taxes exceed government expenditures, then we say that the government is running a budget surplus, and this is unfortunately for the U.S., not a frequent occurrence. The last time we saw this was in the 90s under Clinton. Budget deficits tend to be the norm, whereby the government is spending in excess the amount of taxes collected, and typically this is financed through bond sales. And in the event T is exactly equal to G, we refer to this situation as a balanced budget, in which case private savings is equal to zero, such that all of the national savings is accounted for by public savings only. So we also discussed some trends related to the budget deficit. We looked over time. We saw that during war times, the budget deficit tends to spike. Surpluses, again, were a rarity historically. Recent budget deficits were pretty high under the previous administration. They were a little bit lower towards the end of Obama's term, but they have since been increasing. And the budget deficit is projected to hit over $1 billion in the next year. So they have been increasing as of late. Back to the loanable funds market model that we've been dealing with, the supply curve in that market is going to be determined by the amount of national savings. Note that in our model, national savings does not depend on R because we haven't assumed any component of it depends on R. We could easily change this by assuming that consumption is inversely related to the interest rate, which wouldn't be a horrible assumption. A lot of folks finance consumption goods through credit expenditures, so when the interest rates go up, that may cause consumption to go down. So we could think about that alternative framework. It doesn't really change too much. So in the spirit of keeping things as simple as possible and no simpler, I'm going to proceed with the way that we have outlined the model accordingly. We know our demand for the loans is captured by the investment component of gross domestic product. And now we can think about the process by which supply and demand in the goods market, or equivalently supply and demand in the loanable funds market, are putting pressure on the price in this model, which is the interest rate, towards some equilibrium value, which also simultaneously determines the equilibrium quantity of savings and investment. So again, I cannot emphasize this enough. In our neoclassical model, the interest rate satisfies a very important function in that it is clearing two markets together. R is adjusting to equilibrate both the goods market and the market for loanable funds simultaneously. Okay, one implies the other, and it's a little bit easier for us to look at the market for loanable funds, and that is the typical standard treatment. We look at that market model of supply and demand, knowing that in that equilibrium, it's also putting the equilibrium for goods and services. It's imposing that market equilibrium in the market for goods and services, rather. So just to recall our discussion of how to master a supply and demand model, first thing we wanted to be able to do is for each curve in the diagram, for both the supply and the demand curves, we wanted to know the definition of these curves, understand the intuition for the slope of these curves, and then understand all of the factors that could potentially shift these curves, which we're going to talk about momentarily. Once we understand that, step two involved us thinking about how a change in the economic climate shifted the curves, which curve shifts, in which direction do they shift. And then the third step in mastering the model was us looking at the evolution from one equilibrium to the new equilibrium once the curves had shifted. Okay, so in order to be able to master this model, we want to know what shifts what curves, and we're going to start by thinking about things that shift the supply curve. Okay, so a couple features that shift the supply curve, which again captured national savings, were any things that affected the components of national savings. For example, anything that affects public savings, running deficits, running surpluses, changes really in fiscal policy variables G or T would also affect the supply curve as a consequence. Anything that affects the private savings or the private incentive to save, for example, changes in preferences towards the future may affect the marginal propensity to consume to change, so that the slope of the consumption function changes for an individual. There could be changes in tax laws that affect private savings, for example, changes in 401k contributions, or changes in the tax avoidance or tax deductible nature of IRA contributions. These are all examples of policies that would incentivize an increase in private savings, not to be excluding of, for example, replacing an income tax with a consumption tax. We're going to look at as a case study very quickly the Reagan deficits. And during the 1980s, Reagan infamously was known for increasing defense spending dramatically, and at the same time offering a gigantic tax cut. And maybe that sounds familiar to you, maybe it doesn't. Both policies, increasing government spending and cutting taxes, move the quantity of government savings down. These are both examples of policies that move us towards deficit spending. We're bringing in less tax revenue. At the same point, we are spending more. So both policies unambiguously here reduce national savings. Increasing government purchases causes G to go up and reduces national savings. Cutting taxes causes consumption to go up because consumption depends on disposable income, and that also reduces national savings. So the end result of these tax cuts would imply that our model predicts that the supply curve for savings will shift to the left. As a result, this puts upward pressure on the equilibrium real interest rate and winds up reducing the quantity of investment, meaning we would have less capital available in the future. Okay, so this is an example by which this deficit spending actually could potentially risk a slowdown in economic growth due to the crowding out of investment. Okay, we can check if the data are consistent with these results, and for the most part, they look pretty good. Okay, in the 1970s, the deficit as a percentage of GDP was around negative 2.2, and that nearly doubles in the 80s, which is consistent with cutting taxes and increasing government spending. You'll notice the quantity of savings decreased in response to that by about 2%. So that's fairly consistent with our model prediction. The other thing that was observed was an increase in the real interest rate, also consistent with the model prediction here. So far, we're shooting 3 for 3. The one feature of the data that's not quite consistent is that the model predicted investment should decrease, but investment turns out not to have dropped too much. And that is a consequence of us assuming that we were in a closed economy framework where net exports are zero. It turns out that if net exports are not zero and we're trading abroad, the domestic demand for investment can be met by a foreign supply of savings, so that even though domestic savings dropped, that doesn't necessarily cause domestic investment to fall. And we're going to come back and revisit this idea when we look at capital flows and exchange rates. However, for now, the phenomenon we're observing is known as the crowding out effect. An increase in the budget deficit caused the quantity of investment to fall. Okay, and again, as the government is borrowing to finance its deficit, this leaves less funds available to loan out to those entrepreneurs trying to start businesses. This phenomena, by which there are fewer funds available because the government has spent them, is known as crowding out. Okay, and when we talk about growth in the long run, okay, one of the key features of long-run growth in standards of living is a society's ability to transfer capital into the future and invest in itself. Okay, so this is the mechanism by which potentially a budget deficit could hurt an economy's long-run standard of living. However, this is a theoretical idea, and there is a lot of empirical research out there that needs to be done to support this. Again, the government finances deficits by borrowing, which it does through the selling of government bonds, and the accumulation of persistent deficits increase the government debt, which we discussed is around $21 trillion, just above the amount of annual GDP in nominal terms of about $19.1 trillion for the U.S. economy. The ratio of government debt to GDP is a pretty useful measure of the government's relative indebtedness relative to its ability to use its income to pay that debt off in a given year. And historically, the debt to GDP ratio usually rises during wartime and falls during peacetime. However, this trend tended to change during the early 80s. So this diagram, I think, is pretty important in demonstrating that historically we have an increase in debt relative to GDP during wartime, but you'll notice during the 80s that trend sort of increased. Now, in terms of mastering the loanable funds model, we thought about the elements that shifted the supply curve for savings. We have yet to discuss the elements that shift the demand curve for investment, but the idea is very similar to what we saw in micro. Anything that affects the demand for investment to make people want to undertake a small business or a business venture that is not related specifically to the price of investment, which was the real interest rate. So any non-real interest rate factors changing would cause the investment curve to shift. Okay, one of the most important factors that will shift the investment demand curve is technological innovation. Any technological improvement which makes the cost of running a business lower, or rather could alternatively increase the future cash inflows of running the business, will make that business more attractive and hence increase investment demand at any level of the real interest rate. The other thing that would help increase or to stimulate investment demand are changes in tax laws that would potentially affect investment demand. For the example, imposing an investment tax credit would make taking out a loan to start a business cheaper, and that would result in stimulating investment demand. So we could think about what would happen in the market if we stimulated an investment demand through something like an investment tax credit. This would shift that demand curve to the right. This would put upward pressure on the equilibrium interest rate. And this would not lead to a change in the level of investment because the amount of funds available through the supply have not changed. Now, I mentioned before that we could think about a model whereby the savings function was upward sloping as a function of R, and that makes sense, right? The higher the interest rate is, the greater of a return you get from saving your money. And we could easily model this if we were thinking about, for example, consumption or some element of demand for our output being negatively related to R. So if consumption was negatively related to R going up causes consumption to go down, which would cause savings to go up and would give us a scenario where we have an upward sloping supply curve. And in this framework, a rightward shift in investment demand would not only push the real interest rate up, but would also lead to a quantity increase in both investment and savings in equilibrium. So that about wraps up our preliminary analysis of the neoclassical model of loanable funds. And what we will discuss in the next set of video segments is a brief review of what is known as the quantity theory of money. This is how we will explain the long-run relationship between monetary policy and prices. With the Fisher effect, this theory is able to explain the effects of long-run money growth on nominal interest rates. To juxtapose that to the last model of loanable funds that we looked at, which determined the real interest rate. And the quantity theory of money also explains the long-run inflation rate. So we will see you in the next video session when we will discuss the long-run behavior of money, inflation, and prices. Hope you enjoyed. See you soon. Bye.